the markets have been on a tear. They simply don't believe it's true. The major US averages are all at or near all-time highs before today's losses. And investors have been hoping the Fed would cut rates in the near. Now, it looks like they might have to last or wait just that little bit longer. Kristina Hooper is the Chief Global Market Strategist at Invesco. She's with me. Now, when you and I speak, I try desperately not to make one swallow into a summer, or whatever that phrase is, or one magpie into a winter. But if you take this number, it's pretty clear the Fed couldn't cut in March.
Richard, I agree with that given what we've heard from the Fed, but that's okay. I don't think there's a huge difference between March 19th and May 1st, which is the following Fed meeting. I think it's much more important to see the level of cuts in 2024 than whether the cuts start in March or May.
But the issue becomes not just the cuts, but, well, obviously, to one extent, but whether or not these, I would say, stubborn rates mean that the Fed simply pushes it way down the track. Because at these current rates, will it come to 2% on its own?
Well, if we were to strip out shelter, and it was really one component of shelter that was problematic, but if we were to strip that out and we looked at just core CPI, ex shelter, it's running at about 2% annualized for the past 6 months. That is not a terrible number. In fact, it's at the Fed's target. So I think it's important to take a step back and not overreact to this CPI print. It's not what markets had expected. It's not what they expected, but it's not terrible.
No, but don't we need to a certain extent? I understand the significance of core versus headline versus PP5, all the Fed's preferred measure. But shelter is 30 to 40% of people's costs. And you have to see shelter come down, because otherwise, if that, or at least stabilize, because that, arguably more than anything else, will feed into the wage cycle.
Well, shelter tends to lag about 18 months home prices. So we would anticipate that shelter would come down this year. But you're absolutely right. We have to recognize that there are going to be components of inflation that are stickier than others. But that doesn't mean that we're not very much in the midst of a strong disinflationary trend that will continue. Now, of course, the Fed is very nervous about getting to that 2% target, so they are going to err on the side of caution. But I still believe they're going to be satisfied with the data they see between now and the May meeting, and are very likely to cut at that May meeting.
All right. I love the way this, because once they've started cutting, then the cycle's reversing. And we really do need to then pay extra attention that nothing frothy is starting underneath.
That is true. Certainly, that's always the concern, right? That we see that resurgence in inflation.
Right.
But nothing I'm seeing today suggests that we're going to see any big surge in inflation. In fact, what we're just seeing now are imperfect data points, which we will see, and we've seen in past disinflationary trends. But that doesn't suggest any kind of surge. I look at consumer inflation expectations. I think that's important. The Fed thinks that's important. And consumer inflation expectations are very tame, and they can be very, very predictive because they are self-fulfilling prophecies. And to me, that helps support the argument that we're headed towards that 2% target.
I'm grateful. Thank you. Tame numbers. That's what we like to hear. Tame numbers. Good to see you. Thank you.